Thank you for joining us for this webinar. We have over 70 registered participants. I can see us slowly rolling in. Just to go through the normal rules of how we're running our video conferencing systems, as is possibly the most famous phrase for 2020, please keep your mics on mute. That would help us all exchange views. And also, please, we'd like this to be an interactive session between us all. So obviously we have our panelists who will be giving their insights and their views, but also we're very open to an exchange with attendees. So please, we're open to listening to feedback and input from the audience. This will be done through Q&A, so please send your Q&As in through the Q&A function at the bottom, which is available to all of you. And just for your information as well, the session will be recorded and will be available live after the event. So those are sort of formalities on how we're working the webinar forward. The purpose of the webinar, well, the idea of this webinar was to take a snapshot of today, where do we stand, and see whether we can use this to project Q4 going forward. What should we be expecting? Is it going to be the creation of a perfect storm in Q4? Or could we start seeing signs of a blue sky? This is the idea of why we titled the webinar in this way. And obviously I'm looking forward to hear Chris from Saxo Bank. Thank you, Chris, for joining us from Paris. Steve Alou from BOV Asset Management. Thank you, Steve, for joining us. And Matthew from Wealth Management. Thanks, Matthew, for joining us as well. We'll be hearing your views. But obviously, before we kick off this exchange, we have the Deputy President of the Chamber. Thank you, Marisa, for joining us. I'll give you the floor to set the scene for us, and then we'll follow on with Chris. Marisa, I give you the floor. Thank you.
Yes. Good afternoon. Thank you, Mark Cicluna Bartoli, Christopher Dembeek, Matthew Farrugia, Steve Alou. Such a pleasure to have you with us. I'm really looking forward to listen more than to talk in this webinar. But of course, just to set the tone, we've seen COVID present us with some very unique challenges, and we're pleased to see our businesses rise up to some of those challenges. There are opportunities to be had in terms of digitization, for example, reskilling and upskilling of the labor force, re-engineering. We're seeing a lot of companies also look more at R&D, for example, than we've been used to doing in previous years when we were too busy to think about this. There are, of course, some real risks. The obvious ones, when you are in a crisis and you don't know how long it's going to run, liquidity is the first one that comes to mind. And we are also concerned about the impact on the labor force, on the current labor force in terms of losing people with skills, and also on the future labor force when you think about the impact that this pandemic could have on education, for example. So there are some real risks that we are concerned about. The Chamber has been at the forefront in terms of proposing initiatives to try to address these risks. Things like mobilizing labor supply, having a continued flow of liquidity for businesses, initiatives to jumpstart the economy in particular sectors that hold promise, and also to stimulate innovation. We have just presented our budget recommendations for the government budget for 2021. And we've based those recommendations on 3 pillars, being to recover the economy, to stimulate reinvention, and to entice reinvestment. And I hope that from this seminar, we will get some more ideas and some more inspiration, and also some questions that will help us in formulating our policy positions and being more effective as a chamber in addressing the real needs of businesses in the coming months. So, the floor to you. Thank you.
Thank you, Marisa Shriya, for that. It's good to know sort of the view of the chamber and even how we could maybe share some views in our exchange. From there, I'll pass on to Chris. Chris, would you give us a short insight, maybe Europe? Let's start at Europe and then come back down to Malta. I understand you have a presentation which you'll share with us, Chris, and take us through it.
Yeah, good afternoon, everyone. I hope you see very well the presentation.
Yes,
I wanted to, perfect, thank you. I wanted to discuss with you a little bit regarding how will be the situation in the coming months, coming weeks, in terms of economic situation in the European Union. As a matter of fact, I think that we are in a situation where we need to be prepared for a very long-term crisis. And this is one of the things that we need to understand quite well. I will show you just some of the slides. Just let me 1 second to show you the slides. I think one of the key points is that this is a very unique situation in terms of economic crisis. We have seen before the crisis that you have already a lot of imbalance before the COVID-19. I mean, in terms of financial repression, a very high level of debt. Obviously, inequality was also one of the questions. You had rising populism, politics was in very bad shape, and also you had already an economic slowdown. So what I want to say is that economic situation before the crisis, I mean, was already in very bad shape. And let's say we will not have had the COVID-19, we would anyway at one point in the coming years, in very short term, had a recession. The new world with the COVID-19 is that we were not expecting, obviously, and I think no one was expecting that we could face a pandemic, at least at the global level, with such a strong impact on lockdown. But what is interesting is that the situation will actually trigger new paradigm, I think. And I see a lot of new mega trends in the coming years that were already in place before the crisis, but that will probably increase quite fast. You have, of course, central banks that are key players, and they will have a strong impact in the coming years. We had yesterday the Federal Reserve. This is a clear signal that central bank will continue to support the economy. I think in some countries we are seeing a rising state capitalism. What do I mean by that is that we cannot allow to have very high unemployment. We cannot allow to have job skills losses, skill talents that we lose forever. So what's gonna happen is that on one side of the economy, you will have central bank that will step in, continue to step in, but at the same time, we have seen that most of the governments have done their maximum, whatever it takes, in order to avoid the situation to deteriorate further. And obviously, other trends like deglobalization, automation, remote work, obviously all getting green with green investment will probably be the new theme in this kind of post-COVID-19 world. So if we take a look at the situation, obviously it is quite unusual, as I said, but I think the best way to understand what we are going through is to get back in the past, and actually especially to the Spanish flu. If we look at the previous pandemic, we need to understand, and I think a lot of countries in the European Union are on the bridge of a second wave. Maybe we will have, hopefully, we will have less fatalities, but at the same time, I think the number of cases is increasing quite fast in many countries. I was on the phone with a Spanish investor like 30 minutes ago, and he told me the situation is as bad as in March before the lockdown. So we need to understand that we are not getting out from the crisis, but it will have a long-term negative impact. And especially the coming months will be probably very challenging because we need to deal with the COVID-19, but on top of it, we also need to deal with the seasonal flu. And I'm not sure that all the countries are able to cope with the situation, especially hospitals. So it might be, again, quite challenging. I think everyone understands that we are not facing any more risk of national lockdown because the economic cost is way too high. But as a matter of fact, we cannot consider we are getting out of the crisis yet, at least. I think a key factor that we need to understand is that, as I said, I might sound a bit gloomy, but there is a very bright side. The bright side is that considering the situation, it could have been much worse. But fortunately, what we had were governments, but also central banks. Central banks step in quite fast in order to avoid the crisis, to avoid liquidity issue, especially in order to provide credit at low cost to companies and to households. And we see that this document is interesting because it shows you that nowadays, central banks in the developed world, they own between 25% to 50% of government debt. So what does that mean? That means when politicians say that public debt, at least public debt, is not an issue in the short and medium term, they are right, because nowadays we are in a situation where central banks and governments are collaborating in order to fight against the crisis, in order to have enough liquidity and to be able to finance the way to support the economy. So we are what we called in a new period where central banks are key market players, and I think this period will last quite long. What does it mean? It means that we cannot only look at public debt the same way we were looking at it in the 80s. We cannot consider that interest rates will jump from one day to another. I think what we need to understand is interest rates will stay extremely low for a very long period of time. But public debt, yes, will be quite high in percentage of GDP, but central banks will do their best to buy as much as needed public debt in order to avoid interest rates to increase. So we cannot compare with what was the situation in the 80s or 90s, and I don't expect that despite very high level of public debt, that we will face at any time soon a debt crisis in the United States or even in the European Union. So I'm very confident. This is a bright side, I would say. Regarding fiscal situation, I mean, most of the government, I think, at the European Union level has reacted quite smoothly, the right way. The problem is, once again, I might sound a bit critical, but this is at the European Union level. They acted quite fast, I have to say. But the problem is that the fiscal stimulus from the European Union is way too small. I mean, what is called the next generation European Union is around 750 billion euro. This is both grant and loan. And if you take a look, I did it for Malta, you see how much you will get, which is extremely low. It will represent only 0.3% of net GDP. So what does that mean? It means that, yes, nowadays, European Union leaders did not take ages to react. They understood the crisis was deep enough in order to speed up talks. But at the same time, you don't have such a strong European solidarity, and most of governments needs to count on themselves and the European Central Bank to finance the post-crisis period. So I will be a bit skeptical regarding what has done the European Union. It's good, but I would say they can do much, much better, and they should get inspired by what has been done by, for once, by the UK or even by the United States. The bad part is, I think, as I said, the worst of the crisis is not behind us yet. And I think we will face quite, we are already facing it, and in many European countries, which is the solvency crisis, which will be the biggest issue. Yes, as I said, the central bank provide liquidity to the market. They have done their best to avoid the liquidity crisis, but we cannot avoid the solvency crisis. And if you take a look at this chart, I mean, you see that you have a short-term liquidity impact and profitability impact in 2020. What is interesting is that in the worst situation, with very negative short-term liquidity impact and very negative impact on profitability, which kind of sector do you have? You have retail, airlines, and tourism and travel. So we know in this kind of very specific sectors, in service sectors, you will have a very negative and long-term impact, which means bankruptcies, which means also at the same time a lot of higher unemployment. So we are in the situation in the service sector where you have a reshaping of the economy. It will get bad, but it will get better at one point. The situation will probably improve, but it means we are facing at least 1 or 2 years of challenges for some economic sectors. What does it mean concretely? It means that the governments will probably, in most of European countries, still support, maybe with unemployment benefits, maybe with some direct subsidies, maybe with financing. They will do their best to avoid too much bankruptcies. But this is good in terms of politics. You need to do it because you cannot afford to have very high unemployment. But at the same time, we need to understand this is not healthy for the economy to have what we call zombie companies that will stay alive for years, for 2, 3, 4, 5 years. This is not good for productivity. This is not good also for innovation. So that's why I perfectly understand the political point of view is that we cannot afford unemployment, and especially when we fall into unemployment, it is quite often very hard to get out from it. But we need to understand that if we move in an economy where you have this kind of zombification of some companies, of some economic sectors, it will have a long-term negative impact on productivity and innovation. So we need to be aware of that. I know which path most governments will follow, the path of saving companies, as even if companies are not in good shape. But as a matter of fact, we need to understand that maybe we will stand with an impact negative in the long run for many economic sectors. As I said, the travel industry will be one of facing the biggest challenges, and I see that already many countries try to stimulate the travel industry, especially with domestic travels mostly, and we can do that in the European Union. We are lucky for that. Regarding the latest forecast, I mean, they are still pessimistic, but I think it's a kind of fair level. They expect that the travel industry will register its biggest decline ever. Economic losses should reach 1.1 trillion euro this year. Some countries, as you can see, you have all the European Union and some other countries with the share of tourism GDP as a share of GDP. And you can see that, yes, Malta, the contribution is quite high. If you total contribution is around 25% of GDP, which is one of the countries where obviously the tourism, the travel industry is one of the key sectors to focus on. But you have some economies that are even much exposed situation. If you take a look at Portugal or Spain, where it is almost 30% of GDP if you take into account direct and indirect contribution. What I want to say for the European Union, we know that there will be this gap between economies that from the north of the European Union that will be probably in rather good shape because they were, before the COVID, they were already in very good situation in terms of debt, economic situation. But the issue is that Southern Europe, Spain, Italy, Portugal, not even talk about Greece, I mean, their situation will deteriorate much further, which means that these kind of countries, they won't be able to get back to pre-COVID level anytime soon, which means that we need to find some way to move towards much more solidarity at the European Union level, and that the European Central Bank is doing the job, and it will need to do the job for the coming years. This is my last slide before we have a discussion. What I want to give you is that based on the different economic sectors, we have a kind of view of what's going to happen, some sort of a time frame of recovery. What we know very clearly is that this crisis will take a very long time to recover. We had this kind of V-shaped recovery at first after the lockdown, but we are still minus 20–15% of economic activity compared to the level before the lockdown. And this 15–20%, it will take a lot of time to recover. And I might sound a bit optimistic, like for travel and airline companies. And you see the recovery, we expect a recovery mostly in 2023. A few days ago, I had a short talk with a top manager at Air France, and their forecast is even much more pessimistic. They expect that the market will get back to normal in 2025. What I want to say, I don't want to scare anyone because we know forecast in such long period, we don't know what's going to happen. And you can read any analysis regarding economic forecast from last year, and you will see it was completely wrong and big mistake. But at the moment, with what we know, that we don't have vaccine, with that the virus is still spreading in many countries, we know that it will change for quite a long period of time consumer behavior. And that's why actually a lot of service sectors are the most exposed to this crisis. And I don't know, I haven't been to Malta, obviously, in recent months, but if you walk by in big European cities, if you walk by in Paris, all the shops are closing. The situation is that obviously the shops that are closing were already in not very good economic situation before the COVID. But I think we are facing a situation where we will have much more actually destructive creation in the coming months, coming years in the service sectors. So that it will be the biggest part. It is not all negative, because I think what we need to understand is that all the governments acted very fast. We have done a good job to avoid a much deeper negative impact. If you look at what is happening in countries that has less fiscal or monetary leverage, let's take a look at India. I mean, the situation is extremely bad. India was considered to be one of the top economies in 2030. Nowadays, the economy is completely destroyed. They go from lockdown period to another lockdown period. So what I want to say is that I think policymakers, most of the time, they took the right decision. And central banks, they have done an amazing job. So we are not yet out of the crisis, but I think we should be optimistic because we have done the best in the worst economic situation ever. So that's it. I try not to be too gloomy, so I think we can, that's the last part for my presentation. And obviously, if you have any question, I will be more than happy to answer.
Thank you, Chris. I think if I had to summarize is Europe could have done more faster. I think when I look at it operationally on the ground, your statistics would even take long to come to the businesses because they are still discussing at a Brussels level of how to implement European guarantee funds. So in truth, businesses need the cash injection now.
Yes.
It's not clearly going to happen in 2020. It's going to happen in 2021. So that is potentially one. The North and South divide is also a very valid point. Thanks for bringing it up. Actually, the FT brought it up today as well, where you have a two-speed Europe running economically. But I think if I were to distill it as well, we're going to need to go potentially through the eye of the storm before we see some blue sky, is a feeling.
Yes.
There's also another complexity, which is Brexit. These last 2 weeks have shown us that it's going to get messy from the little I saw. You could see forecasts like the LSE is presenting forecasts that Brexit is going to hit the UK economy potentially even worse than COVID. UK government economists are saying that it potentially will decrease by 5%, even more GDP. But looking at it from a European perspective, Chris, how are you seeing the impacts? I mean, yesterday, the FT was saying that from a financial services perspective, they're going to try and create some space to keep the markets going. How are you seeing it more on the ground from an economic perspective, vis-a-vis Brexit, supply chains? Your insights would be valuable there.
What I see is that most of the European companies and most of the European countries are completely prepared to a hard Brexit or even a thin deal. I don't think that we will have such a strong impact on the supply chain. And you have some economic sectors that are obviously much more exposed, like if you take a look at the automotive sectors, Germany is obviously very exposed in terms of trade to the UK. But as a matter of fact, most of big companies, government, had at least 2 years, even more than 2 years, to really prepare, because we understood already very early that we could face a hard Brexit, and negotiation process was extremely complicated. So, and I think this is the way policymakers at the European Union level think. They don't consider this is the top risk, and I clearly agree with them. We have much more things to deal with. Thin deal or no deal, I think the biggest impact, negative impact, will be on the UK. I clearly don't think that it will cost in terms of economic activity much more to the European Union. I see a lot of economic sectors are very resilient, well prepared, and in the worst case scenario, governments are ready to implement some support, financial support, in case it goes really bad. So that's why also, I guess, to explain why European Union leaders, they don't really want to spend so much time talking about Brexit, because at the end of the day, in terms of economic situation, it will be mostly the UK that will need to bear the economic consequences. So for me, this is one of the risks. If I need to classify it, maybe number 3, number 4 for the European Union. But for the economy, I'm kind of confident. I mean, I am much more afraid of the scale of bankruptcies than of the negative impact of no-deal Brexit. So, and especially because maybe I am mistaken, but I still expect at the end of the day, by the end of the year, obviously, we'll have some kind of deal. Not the perfect deal, clearly it won't cover everything. I am quite confident about it, but we will have at least some kind of deal to save the face and to be able also to negotiate something else in the longer run. So I'm confident, and even when I discuss with some European banks that have their offices in London, what is very interesting is, like 2 years ago, everyone said, no, but we need to move to Luxembourg, we need to move to Dublin, even Paris. Nowadays, they say, stop. I think even in case of no deal, we can still make a way to do business. We don't need to move so much of our team to continental European continent, continental Europe, sorry, or to Paris, etc. So I think there is a change of mind also in the business community, considering that Brexit, no deal Brexit obviously is not the best way, but we can overcome the issue much easier than anything else.
Thanks, Chris, for that. I think what's nice is you actually gave it a sense of perspective, well, in the sense that whilst it was something which was worrying us around a year and a half ago, we clearly have much bigger things on our plate at the moment. So thanks for giving it that perspective. If I were to move a little bit closer to home, Steve, I'll come to you. How do you see sort of the impact on how the European economy currently presented by Chris would cascade down at a Malta level, sort of? Which are the sectors of the Maltese economy which potentially are being mostly hit by this COVID pandemic? And do you see potentially a different resilience in the Maltese market or no? I mean, Chris clearly mentioned that there is this north-south divide in Europe where you have Germany going full speed ahead, while Spain and Portugal, Greece, it starts coming closer to home. Are we sitting in the Spanish basket, or are we sitting in the German basket? What's your take, Steve? Where do we stand?
Thanks for this, and thanks for having me on the panel as well. I think that we're in a situation where, in reality, I wouldn't say just Europe, of course, the entire globe has been hit by one systematic risk, which is pretty much affecting everyone in a very similar fashion. So this two-speed growth, structural growth issue in Europe is obviously there, has been having an impact for the last decade or so. And I think it was also exacerbated by the fact that monetary policy, a common monetary policy across the European Union or across the Eurozone, was not having the same kind of impact in different economies. Said that, however, in my opinion, the current situation and the pandemic impact have had an effect which is pretty much consistent across different economies. So I think the magnitude of the impact that COVID has had recently and is going to have in the coming months will probably overshadow this two-speed economic growth model, which is existent and is something which we will definitely need to try to handle in the future. Although, in my modest opinion, with a common currency and a common monetary policy, I see very real and tangible possibility to mitigate and bridge these differences between different countries. So that's something which we'll need to discuss perhaps at a later stage. In the Maltese economy, I think the depiction that Chris gave us in terms of the COVID impact on the European economy and in various sectors, I would say it's pretty much reflective on the Maltese scenario as well. So we're having a situation, of course, where tourism is what it is. It's practically non-existent. Ramifications across different sectors. I mean, we all know the story, and this is the situation on the ground. In my opinion, though, and perhaps I could tie into some arguments being raised by Chris, but also the initial comments made by Marisa. I think that the current situation and the entire COVID pandemic allows us to, as a country, as an economy, to stop and think and rethink. And I am seeing this kind of regeneration and re-engineering attitude being taken by different companies, different boards across the board. And I might sound a little bit more positive, but I feel that COVID has allowed us to really, and motivated many CEOs and many companies to actually take steps which were put on the back burner in the last decade. And I think this is something which we really need to think on, because I totally concur with Chris's views. I think that probably, and this has been mentioned also by the Malta International Airport very recently. They are looking at numbers only coming closer to 2019 levels, only 3 years, perhaps 4 years down the line, and that's a best case scenario. So in reality, I think what really needs to be done at this stage is to adapt to this current situation, because we will have lower volumes in terms of tourism. We will probably have lower volume in terms of business across the board. So we will need to make the best out of quality. So I think digitalization is key here. My strong recommendation to business owners and to people taking strategic decisions in businesses is definitely to boost digitalization. This is something which is definitely not new. It's something which has been on the agenda on many board meetings for the last years, but it's something which we really cannot shy away at this stage. And in my opinion, digitalization needs to be boosted quite horizontally across different sectors. So I don't see digitalization as being a specific silo, but digitalization needs to be taken into consideration across different sectors, particularly the traditional sectors which have been shy traditionally from taking up these steps. We also need to target value and quality in everything that we do. Tourism is a brilliant case in point, in my opinion. We will never have, or we will not have, the numbers we were used to in the coming months, in the coming years. So we will need to step up quality, and our products need to improve. Our sectors need to be more quality driven rather than volume driven. And also, I think it's very important to nurture sustainability. I take cue from the current pre-budget document, which seems to be deriving this sustainability idea home. But I think what is important is also at European level to nurture the Green New Deal. It's something which has been topical, and there is a major risk, in my opinion, that the entire COVID situation might put the Green New Deal on the back burner. And that would be a strategic mistake, in my opinion, and would have significant impact on different sectors in smaller economies like ours. I see this environmental sustainability
My understanding is I think Steve's connection has fallen. But just to wrap up, maybe onto Steve's point, I understand, yes, that there is a certain degree of change that's going to need to take place in the Maltese economy, particularly in the number of businesses to be able to go forward. I like the idea of tourism potentially focusing more on quality, And maybe hopefully our statistics will be more on tourist spend rather than tourist numbers. I think is going to be something which would naturally need to move to. Sustainability is another discussion. I'd like to bring it up potentially later on in this session, but a point that was lingering in my head as well, which I wanted to bring Matthew into the discussion, is Chris and Steve highlighted a difficulty in the economic markets vis-a-vis businesses and how they are operating. But when one looks at the markets from a financial perspective, the US stock market has grown incredibly. I mean, what's happening, Matt? There's a complete disconnect. I mean, if businesses are feeling a problem to generate revenue, Chris is highlighting that there could be solvency issues where companies go bankrupt and the markets are flying. There's a complete disconnect. No, is it happening in Malta as well? I'd love to get your views on that.
So first of all, thank you to the Malta Chamber for inviting me, and thank you, Chris, for a really good presentation. Really enjoyed listening to that. So to come back to your question, Mark, we've heard a lot of comments about the divorce between the underlying economy and the markets, right? So we've seen, like you said, we've seen market prices shoot up. We've seen the economy is basically crumble, and we're trying to get a hold of why this is happening. And so since we're focusing mostly now, we're going to focus on markets and market prices. We've heard a lot about the underlying economy, and what has been said so far has been, in my opinion, totally on point. But we have to focus on something which is more specific to financial markets. And the part I want to focus on, the segment I want to focus on, is liquidity, because that is a big driver which explains the difference between the underlying economic crisis and the financial markets doing so well, really. So to speak about liquidity, for the sake of our audience who might not be privy to the details, it's best to explain a little bit about how liquidity works, right? So basically, the more buyers, the more sellers there are in a market, the greater the liquidity of that market, which means if I want to sell something, I can find a buyer more easily. If I want to buy something, I can find a seller more easily. That's basically the long and the short of it. So what we've seen internationally is that buyers and sellers, they might have remained the same in the markets. We've had the same number of players, but the only difference is that one new player entered the market. The only difference is that this one new player is actually the central bank, and it's basically a gigantic market player, and he's or she's coming into the market and saying, I'm willing to buy, I don't care, I'm going to buy all the sovereign bonds, just keep selling to me. I'm going to buy the corporate bonds, keep selling to me. And if you know you have a gigantic buyer with very deep pockets, they're so deep he can just print money whenever he or she wants, well, then it's going to start affecting the market. So that starts to explain why we see market prices going up. But the economic crisis is still more or less unfolding, and we still need to recover from it. That's internationally. Locally, we have that to some extent. We know that the Central Bank of Malta is part of the ECB. We know the Central Bank of Malta is part of the asset purchasing program. But then we've got local, the local markets, the local equity market. We've got the local corporate bond market. And over here, I'd like to share just a slide, one slide, because when you're speaking about prices, it's kind of hard to envision what I mean. So over here, we've got 4 sets of different prices. We've got the local market. I've put them all on top of one on top of the other. So we've got the Malta Government Bond Index from the Malta Stock Exchange in dark, a little bit lighter. There's the Corporate Bond Index. And over here, you can notice that the local equity index, the Malta Stock Exchange Index, is very, very low in comparison to the others. So what I'd like to focus on is liquidity in terms of the corporate bond market. So over here, if you notice the corporate bond market, the local corporate bond market in purple, it's much, much more stable than not just the high yield or the non-investment grade bond market. So for those who do not understand credit ratings, high yield, or sometimes called junk bonds or sometimes called non-investment grade bonds, they're much more risky in terms of credit. So you're much less likely to get your money back than, for example, investment grade bonds. So what we notice here that the local bond market, despite being mostly unrated in terms of credit ratings, it's much more stable. So we noticed during the COVID crisis right over here, where I'm pointing out, the prices of bonds fell much less than, for example, not just high yield, but investment grade bonds, which is quite a big deal. And this speaks to the stability of local prices. What drives this? Is it just that local companies are super resilient? On the one hand, yes, we all know Maltese, we've got, honestly, I think we've got a bit of a knack for business. So there's that on the one hand. We're quite a resourceful people. We don't have many resources. We aren't gifted naturally. So we have to make do with what we have and kind of innovate, like Steve was urging us to do. We have to innovate and make something out of nothing. So we're good at that. But a big driver of this stability is the lack of liquidity. So it's like the opposite of what's going on internationally, has been going on for many years in the corporate bond market. The lack of liquidity means that there is an illusion of stability. So bonds don't trade as often, and between one trade and another, the price remains stable. And for the investor who doesn't know this, it might mean, he might interpret that as to mean that the price is just a sign that the company is stable, when it just means that it hasn't been traded on the market. It's something very interesting. Now, to focus on the equity market, on the other hand, we see that there's a massive difference between the Malta Stock Exchange in purple and the performance of the Euro stocks. Now, to be clear, the Euro stocks index is not one of the best performers by far. If you compare to the S&P, it's a bit of a laggard. It's quite a laggard, actually. But the Malta Stock Exchange, on the other hand, the index has fallen almost down to 75% of its initial value at the beginning of the year. One thing which is, on the one hand, it's worrying, but on the other hand, it's encouraging, is that the Malta Stock Exchange is one of the few indices in Europe where we've actually reached a bottom beyond the bottom reached in COVID. So we've seen a bit of a recovery post-COVID over here, but then we've actually broken through that bottom and have gone further down. Now, this is not unexpected. Like we've heard throughout the presentation, Malta is heavily dependent on exports and the export economies, tourism, etc., etc. Why am I saying this is encouraging? It seems a little bit paradoxical. It's encouraging because this, to me, is a sign that there is rational pricing in within the local market. Let's not forget, an index is not just, an equity index is not just something that's static. It changes. Weights of companies, they change in it. And if we follow Steve's advice and if we start shifting to more advantageous sectors and companies start providing new products, new services that will take us into the next decade, the next 2 decades, the weightings in this index will change. The Maltese economy will adapt. And as you can see from this chart, the Maltese investor is ready to take that into account. And one last point is, even though we're not a very liquid market, that does not mean that local investors do not care about underlying risk. As I'm sure Marisa can attest, local businesses, we're like a community, basically. We're a very small country, and we mostly know the goings on of one another, and we know CEOs, and we know the plans of this company and the plans of that company, and we know what's a quality company and what's less of a quality company. And that means that information locally is passed around much more efficiently than internationally as well, because you've got large companies, they're very distant from one another. In Malta, it's different. It's like living in a city where you barely know anyone versus living in a village where everybody knows you, you know everyone. And yes, it's a bit frustrating, but it's nice to live in a community too. So that's basically my explanation.
Thanks, Matthew, for that. It was nice to see how you split up the bond market and the equity markets and how they both reacted with central bank intervention. And it's also nice to see that the Maltese investor potentially is looking long term and still seeing the pains. So what I really gather here is that it's going to be a perfect storm potentially before we see any blue sky. I want to latch on to a point when I was seeing yours from a bond market perspective, Matthew, and the point Steve mentioned. A couple of days ago, the German government issued its first green bond. Subscription was 3 times the amount that was issued. Yesterday, the president of the European Commission presented her State of the Union address, which was heavily positioned vis-a-vis the green and climate change. When we're going, now I need to come down more to the ground here, because deep down I have an environmental vein running through me, but when I listen to this discussion and I see the pains businesses are passing through, is Brussels really living in a bubble, is my question. And I see Steve's positivity to it, and even I want to have it, but I mean, when you operate in the business and you go down, is this really a bubble that's waiting to burst? Or is it something that's really going to take us through? I'd love a just short round, Chris, Steve, Matthew, your thoughts on this. Chris.
Okay, perfect. Well, I think this is a mega trend, and we cannot fight against it. If we look in the US, what is amazingly surprising is in mid-July, Biden clearly presented a climate change plan. I think it was worth 2.5% of GDP over 4 years. And what was interesting, I think for once, we should get inspired by the US approach, at least from the Democrats, which means that they want to focus on energy efficiency. They want to focus on, at the same time, on infrastructure, and they understand that nuclear energy is probably the easiest way nowadays to fight against climate change and be less dependent from fossil energy. We know that renewable energy are not up to the task yet, maybe in a few years, but nowadays we will still be dependent from fossil energy. So the only way is to move toward nuclear energy. And the thing is that in the European Union, we know very well there is this debate regarding nuclear energy. Is it green enough? Yes, no. We know that in Germany, they choose to get out from green energy, from nuclear energy, sorry. So I think for once, I don't know what's going to happen with the US election, but as a matter of fact, I strongly believe that this very pragmatical approach regarding climate change and the way we need to mitigate it that is proposed by Biden team is the right way to do so. And I think we should move to this way in the coming years also in Europe.
Steve.
Yes, in my opinion, I'm not sure whether you can hear me.
Yes,
properly.
we can hear you clearly.
I totally see the risk that you are mentioning. That's something I talked about earlier on. In my opinion, we shouldn't miss the boat here. The European Commission is pretty much strong, as you said, on this direction. And in my opinion, the only way, the best way to make it happen is to make it profitable. What I'm saying here is that I see the possibility of making environment benign investment and ESG investing a pillar for growth. We shouldn't be looking at environment sustainability as a cost, but from a corporate perspective, in our boardrooms, we really need to think into ways how we can make environment sustainable investment, feasible and lucrative. The moment you can generate bottom line earnings, the moment you can generate profitability out of sustainability, it would be a win-win. And I can give some examples here. Even locally, we've had some companies, quite a number of them actually, some of them coming from sectors which are not really renowned for being environment benign or supportive of the environment, actually coming to the market, specifically to the capital market, and borrowing money, not just from banks, but also from the capital market itself, specifically for green projects. This has been done exclusively because these green projects are actually profitable and lucrative. So in my opinion, this ties into the current COVID situation. We're in a situation where at economic level, at macro level, where we've seen obviously a lot of economic growth and domestic demand and consumption in general being diluted. In my opinion, environment sustainability is one of the key areas out of which we can actually generate growth. One of them is, one way to actually do it is for governments to support these initiatives from a fiscal perspective. Let us imagine a situation where governments, and this happened in Germany very recently, as you actually pointed out, when governments actually support from a fiscal perspective, perhaps through lower taxation, for example, of environment sustainable projects. Perhaps even enabling the divide between providers of capital and companies actually seeking that capital to finance environment projects. So these are areas we really need to think of in order to make the Green New Deal happen. First of all, because it's a need, it's an environment need, it's quality, the concept of having a better quality of life. That's a primary objective. But if we can make this feasible for our businesses, it will be our entrepreneurial attitude that will actually drive this change. And I think one other area which we really need to think of, particularly in the short term, is to support consumption, support demand. This ties into what I was saying before. If consumption demand has been diluted through COVID-19, we really need to think into ways that we can spare up that demand again. And the reduction of consumption taxes perhaps could be one other solution here, because the charts brought about by Matthew are of course very indicative of the local market. A lot of visibility is lacking, of course. Company CEOs, even all these company meetings, you really cannot get any visibility because CEOs do not have visibility in the coming years. So we really need to help this visibility and help our businesses, perhaps through supporting providing support in those areas where consumption can be actually provided, perhaps through lower fiscal or improved fiscal support.
Clear. Thanks, Steve. I'll come to you on this, on consumption, but just I wanted Matthew's views on the climate ESG side, because obviously the Commission is coming first to you guys at Wealth Management to the disclosure regulation that's coming into effect by the 10th of March. How do you see this working in the market, or do we still lack significant amounts of data to make it work?
The data is already in place, and actually there are quite a few providers of that data who are out to make quite a bit of money from helping different financial institutions cope with the new ESG regulation, which it's quite important to take into account number one, the environmental damage, or trying to limit environmental damage from commercial activities, being a socially responsible company, and obviously running your company well, having good governance. These are almost obvious things. One thing I would like to point out though is, although I agree with everything, one thing that COVID taught us with regards to the vaccines is that incentives matter. So rather than a simple focus on let's get out all this demand for clean energy, which is very good, we should also focus on creating those incentives for producing clean energy in a more efficient way, because that is the market's way of promoting green energy. Yeah, that's it.
Clear. There is a question from one of the attendees that makes reference to medium-long term. Are you worried about inflation? Steve was mentioning earlier in his exchange, we should stimulate demand. Valid, I see the point, especially in a small market like Malta, but could it have implications on inflation? I'd love just a short insight. Chris, Steve, Matthew, your view, medium to long-term inflation.
This is actually a debate between economists right now. It's where you have what they call the modern monetary theorists on the one hand, and you've got the more, I guess, orthodox economists who argue that, listen, if we keep using all these resources, if we keep printing all this money, eventually inflation will go up, because that's what the past showed us, at least until 2008. And the truth of the matter is we just don't know. A lot of people were arguing that, listen, eventually inflation is going to go up after 2008. Never happened, but many are just arguing, listen, we just had to wait 5 more years and inflation would have gone up. We just don't know. What we're seeing is that central bank policies are definitely taking a much more relaxed approach to targeting inflation now. So that's interpreted as you will. That could be very worrying if we just, central banks just let inflation go up and they don't care about much else except for growth and inflation. On the other hand, it gives you a bit more slack. So as we saw in 2018, as soon as inflation maybe started going up, we saw a market crash, basically, a market sell-off. Investors were very, very weary of inflation, central bank policy. So we don't know, but central banks will definitely be more relaxed. So if it does come around, I don't think we're going to see hikes in rates immediately. I don't know about my colleagues. They share the same opinion.
Oh, actually, I tend to agree with Matthew's views here. This has been an ongoing debate for the last, since the quantitative easing program rewrote actually the economic books. So it's something which was expected. Inflation was expected in the last decades, but it never actually materialized, despite the fact that we've never seen this kind of monetary policy. Now we're in a situation where we're actually beyond QE, and we're actually into new uncharted territory. We're seeing helicopter money being not just a theoretical concept, but being applied practically across regions, across economies. So just for clarity, helicopter money is literally the dishing out of cash to the population. So all the ingredients are there, in my opinion, if you ask me, for higher inflation in the medium to longer term. I don't see this as a material risk in the short term, but despite the fact that this could be a real possibility in the medium to long term, the same could have been said in the last 5 years. So I guess we have to, as Matthew suggested here, we'll have to sit this one out and we'll take a wait and see approach. I really hope that central bankers across the world still have the inflation target objective at heart. But at this stage, it seems to me that the problems, that the real issues, economic issues facing economies at this moment in time are more, have a bigger magnitude than the potential inflation risk at the moment.
Understood. Chris, your thoughts on inflation? potentially to wrap up? I think Chris, can you hear us? No, it seems like not. Chris, can you hear us? You're on mute. I think it froze. Can you hear us, Chris? You're on mute. Can you unmute yourself? There you are. I think we should be able to hear you now, Chris. No. I'm sorry, I'll have to close it off there then, since we can't hear Chris. Just to wrap up, I wish to thank you all for the insights. I found them valuable. I think the feeling is we're going to have to go into the eye of the storm before we see a blue sky, be it both from an external environment, be it economical, potentially also it being internally, as Steve was alluding to, where we're going to need to do some changes internally that sometimes could be quite radical for us to come out of this stronger. But obviously, I also do understand there's a certain resilience, what we saw even from Matthew's presentation within the Maltese companies, that could take us through, both from a resilience and ability to adapt to change, which is something which us Maltese thankfully have. So with that concluding note, which is half positive and half a little bit negative, I wish everyone the strength to keep looking at it day by day, being positive on it, and adapting slowly to what comes our way. I think taking fast decisions and being able to change them these past 6 months has become a skill we're all adapting. So with that concluding note, I wish to thank everybody and also to all our audience, and we look forward to another exchange in the future. Thank you and good afternoon, everyone. Bye-bye.
Thank you.
Thank you.
Thank you.